When we all finally decide to retire, we know our paycheck stops, and then it's up to us to figure out where to pull our retirement income. This is one of the biggest challenges you'll face after retiring, figuring out where the money's going to come from to support your lifestyle and pay the bills. Should you pull money from your 401k? Should you pull it from your brokerage account? Or should you pull it from your Roth IRA? The order you pull from these accounts can have a surprisingly large impact on the long term success of your retirement plan, especially because there could be significant tax consequences if you pull from the wrong account first. So, in this video, I'm going to walk you through the optimal order to pull money from your retirement accounts. I'll show you real examples so you can see exactly how taxes impact the order you take your money out. And I'll give you practical advice on how to think through retirement income. Because getting this wrong can cost you hundreds of thousands of dollars over the course of your retirement. So let's start with the foundation, mapping out your guaranteed income sources. So think of it like this, like the base of a house. Before you worry about where to pull money from your savings, you need to know what's already coming in the door, right? This includes Social Security, pensions, rental income, or annuity payments. These are your fixed income sources, basically any money that shows up whether you touch your investment accounts or not. And this is important to know because this tells you how big the gap is that you'll need to fill. Let's say you need $10,000 a month to live comfortably in retirement. If Social Security is going to give you $4,000 a month, then you have a $6,000 monthly gap or $72,000 per year that needs to come from your portfolio or from some other income source. Now, here's where it gets tricky. Many people don't realize that the timing of these income sources matters just as much as the amounts. If you retire at 62 but plan to delay Social Security until 70 to maximize your benefit, you might have 8 years where you need to cover that entire $10,000 monthly need from your savings, leaving you with a $120,000 gap at the beginning of your retirement. And this isn't necessarily a bad thing. I often encourage people to retire before they start taking Social Security to give them some space where there's no income coming in. You can take advantage of those low income years to do what's called Roth conversions. Those early retirement years before Social Security kicks in give you incredible flexibility to manage your tax situation and lower your overall lifetime tax bill if you take the time to plan for it. So, know your fixed income sources, know the gap between those sources and your expenses, and know how much you're going to need to pull from your portfolio on an annual basis. Step two is knowing your account types. Now, not all retirement accounts are created equal, right? Each type has its own rules, and understanding these rules is crucial to making smart withdrawal decisions. Now, the first one is the taxable brokerage account. The key word to remember for this one is flexible because there are no rules or penalties for how much or when you can take money out of this account. This is money you've already paid taxes on. When you sell investments in this account, you typically pay capital gains tax on the profit. But here's the best part. If you're in retirement and your taxable income stays under $96,700 when married filing jointly, you could pay zero in capital gains taxes. Staying under that threshold allows you to take all of that income tax free. Next are tax deferred accounts. So the key word to remember for this one is IOU, meaning an IOU to Uncle Sam. Your traditional 401k and IRA is money that gave you a tax deduction when you put it in and it grew tax free. But the IRS is going to want their cut when you take it out. You see, every dollar you pull from this account gets taxed as ordinary income, just like a paycheck. The challenge is depending on your age, either at 73 or 75, the government forces you to take what's called required minimum distributions, whether you want to or not. So, have you been saving and investing over the years in your 401k or IRA? You've been collecting these IOUs to pay the IRS later. And the challenge that often comes up when you retire with the majority of your money in 401ks and IRAs is having large required minimum distributions, which can significantly increase your tax bill in retirement. And finally, there are tax free accounts. And for this one, just remember the phrase the golden goose. Because with your Roth IRA and Roth 401k, this is money you've already paid taxes on, and now it grows and comes out completely tax free. This is often your most valuable money because you'll never pay taxes on it again. So, understanding these three account types and how they're taxed is like knowing which tools to use for which job. Each serves a different purpose in your retirement income strategy. Step three is understanding tax bracket management. Here's where most people get this wrong. They think retirement planning is just about having enough money, but it's really about having enough money and keeping as much of it as possible by paying as little as possible in taxes. Let me show you how this works with a real example. So meet John and Sarah. They have 1.6 million saved across different accounts. John and Sarah both have their 401k. They each have a traditional IRA. John has a $100,000 Roth IRA with Fidelity, and they have their joint taxable account worth $500,000 with a $175,000 cost basis. So they have $325,000 of long-term capital gains in this account. They both plan to retire at age 60, and they need about $70,000 a year to live on in retirement. John and Sarah both plan on taking Social Security at full retirement age, which is 67 for the both of them. John would get $2,800 a month, and Sarah would get $2,900 a month. Now, if they both retire at 60, this leaves them with a 7 to 8 year window without any fixed income sources. Social Security is their only fixed income source. They don't have any pensions, annuities, or real estate. So let's hop over to the tax tab and we'll look at the different scenarios for how they can withdraw this money. Now, the blue on this chart shows John and Sarah's projected taxes that they will pay throughout their retirement, with the various tax brackets represented by these different colored lines here. Now, the most common approach or withdrawal sequence is what I call the pro rata strategy, which is when you take an equal amount from each account type. Now, this may seem logical at first, but you'll find out in a second there's a much more cost effective way of doing it. So rather than the pro rata sequence, let's change it to taking income from our taxable brokerage account first, then our tax deferred retirement accounts, and then lastly, our tax free Roth IRA. And you can see this makes a massive difference, adding over $900,000 more in tax adjusted wealth to the plan. Now, here's how this happens if we look at the tax details. We can see both John and Sarah retire at 60, and for the next 6 years, there are no federal taxes paid, even though they are pulling money from their taxable brokerage accounts. And this is because John and Sarah's taxable income is under the long term capital gains threshold of $96,700 after taking their standard deduction. So they can technically have $126,000 in income and pay nothing in federal taxes. Now, one thing I'm not going to go into great detail here, but I still want to mention it because it becomes very important, and that's the additional impact and tax savings you can get from doing Roth conversions earlier in the lower income years. You can see this little valley here, and this is a great time to consider filling up your tax brackets and moving money from your pre-tax accounts to a Roth IRA. So if we did this and filled up to the 12 to 15% tax bracket, we would add an additional $1.8 million in tax adjusted wealth to the plan, making a huge difference to this retirement plan. And you can see the impact with the conversion. The projected taxes level out, and in this case, completely drop off at age 83 versus not doing the conversions. The projected taxes are obviously much higher. So it's really important to understand the impact of these strategies around taxes. But right now, let's just get back to the main topic on the withdrawal strategy. Now, going back to John and Sarah's gap years, when they are pulling money from their brokerage account, they'll need to be mindful of how this can impact their Social Security and their Medicare premiums, which brings us to step four, understanding the hidden taxes in retirement. First is Social Security. If you pull too much out of your tax deferred accounts, that can cause up to 85% of your Social Security benefit to become taxable depending on your other income. Pull too much from your traditional IRA, and suddenly you're paying taxes on money you thought was originally tax free. This is another reason to consider doing Roth conversions in those early years of retirement. Then there are your Medicare premiums. If you have too high of an income, your Medicare premiums can increase dramatically. And you can see here on the graph the different colored lines representing the Medicare premium increases. We call these IRMAA surcharges, and they can add hundreds of dollars per month to your Medicare costs. Now, in John and Sarah's case, they never reached the threshold where this would affect them, but it's definitely something to be mindful of in your income planning. And the last hidden tax is your required minimum distributions. And honestly, this is the big one. For John and Sarah, it starts at age 75 when the government forces you to start taking money from your traditional retirement accounts, again, whether you need it or not. And we can see those distributions here reaching well above six figures, significantly driving up your tax bill in retirement, pushing you into higher tax brackets right when you're the most vulnerable. This is why some retirees should actually be pulling money from their traditional accounts early in retirement and doing Roth conversions to keep the balance manageable and avoid massive required distributions later. But with anything, there's a delicate balance between how much to take, when to take it, and for how long. Managing the sequence of your withdrawals can make a huge difference in your lifetime tax burden. When you strategically select which accounts you draw money from first, it can really help maximize the long term portfolio value of your investments and help keep your retirement income more secure. Now, this isn't a one size fits all formula for everyone. Your situation might call for a completely different approach. Maybe you need to do Roth conversions early in your retirement years. Maybe you have huge capital gains in your taxable account that completely changes the math. Maybe you're in a state with high state income taxes. All of these can shift the entire withdrawal strategy. Now, if you want to dig deeper on how taxes are impacted in retirement, then watch this video right here. I shared the three biggest tax mistakes I see retirees make in retirement, covering tax gain harvesting, the Social Security tax torpedo, and a deep dive into Roth conversions. So click here to watch, and I'll see you over there.